Some people win big at the stock market while a lot of others lose a lot of money doing stocks. And that's probably why a lot of people have a negative perception of investing. It's reported that almost 62% of Americans owned stock before 2008, but after the recession, the number has not recovered, and only 55% of Americans owned stock in 2019, despite the stock market having rebounded significantly over the past decade. And so people seem to still have the thought that investing is not much better than gambling in terms of making money. So, is investing in stocks the same as gambling? The most common form and legal way of gambling is playing games at a casino. According to a Caesars floor manager, the game with the best chance of winning is at blackjack, with the house only having a 1% edge over the players, and the game with the worst chance of winning, up to 20% with slots. That means for every dollar you put in, you can expect to lose 20 cents over the long term. Those stacked odds against the players is what makes casinos such a profitable business. In 2018, commercial gaming revenue reached almost $42 billion. This means that more people have been losing money to the casinos over the years, except for the shareholders of these businesses. Now, let's look at investing in the stock market. When a company offers its shares to the public through IPOs, the company is offering the opportunity to buy ownership of a portion of the company. So we see the first difference there, where gambling in casino games, you spend money to take a chance at earning money right away, but when you buy shares of a company, you become one of the owners. No one would say that you're gambling if you decided to start a business in an industry that you're experienced in and have done your research in. Investing is akin to starting your own business. You're putting your money in what you think are solid companies and will continue to perform well in the future. Many companies also pay back the shareholders through the form of dividends because, again, you're a part owner and so you get to have some of the company's profits, often on a quarterly basis. And if a company continues to do well, the value of the company will go up as people expect the earnings to go up. So by purchasing stocks, you have two means of earning money. First, through the form of dividend payments, and second, through the rise in share price of the company as the value of the company goes up. One great example of a dividend-paying company is Microsoft. It currently pays its shareholders $2.04 per year for every share of Microsoft you have. The S&P 500 index is a popular index used to track the stock values of 500 large companies listed on the stock exchanges in the United States. Looking at the performances of the index over the years shows the vast differences between putting your money in casinos versus putting your money in stocks. But we also see that there are some dips in the S&P, and that's what makes people afraid to invest. We have seen the index lose about 20% of its value from its highs in the past couple months because of the COVID-19 virus. But if you started investing in 2007, right before the recession, and just kept your money without selling during the recession, you would have almost doubled your money just by doing nothing. Now, there needs to be a distinction made between investing and trading. While both investors and traders put their money in the same stock market, the methods that they use to see profits are very different. Traders try to see better results than investors by buying and selling stocks in a shorter period of time. Most traders do not try to analyze the company's fundamentals. Instead, they try to predict the movement of stock prices through technical analysis and trends. Because trading activities don't look at the fundamentals of the company and instead tries to predict other people's buying and selling actions, it can be an easy way to lose money for a lot of inexperienced people. In summary, while gambling and investing both carry risk and that you may lose money, the similarities end there. Over the long term, we see time and time again that if you invest in good solid companies and hold on to them, you will profit.